Welcome to the deep dive. I often hear people talk about IRS Form 1065, the partnership return, and they think it's basically this big tax bill landing on their desk.
Right.
But what if it's actually holding hidden opportunities? That's our mission today. Unpack this form, show it's really an information report, and how understanding it helps you maximize tax benefits. It's all about that pass-through idea, right? Where everything flows to the partner's K-1.
Absolutely. And that distinction information report versus tax bill, it's not just semantics. It's crucial because it connects directly to your personal tax situation. The partnership itself, it doesn't pay federal income tax.
Okay.
Instead, it all flows through. So the 1065 is the foundation, really the roadmap for what ends up on your own return. It guides your strategy.
So let's get into the numbers on the 1065 then. What are the main categories of income we should look for? Are there, pitfalls or benefits hidden in how things are categorized?
That's a great place to start. There's a really critical distinction. You've got ordinary business income. That's your regular profit from operations.
Right, the day-to-day stuff.
Exactly. And then you have separately stated items. Think of these as special categories. Things like capital gains, Section 179 deductions, even charitable contributions made by the partnership. They aren't just mixed in.
That feels important, that they aren't just blended in. What's the real power behind separating these items out? Why does that matter so much for the partner?
You've nailed it. Because these separately stated items keep their unique tax DNA, let's say. This means they can be subject to different rules, different limits, directly on your individual tax return.
So it's a planning tool.
It's absolutely a strategic tax planning tool. For instance, maybe a capital gain gets taxed at a lower rate for you personally than the ordinary business income would. And what's really interesting is that partnership agreements can sometimes allocate these items strategically.
Strategically? You mean not just based on ownership percentage?
Sometimes, yes. Within limits, agreements can be structured to allocate items in ways that help partners achieve specific tax outcomes. It's quite flexible.
That's fascinating. Okay, so we've got these classifications. Now, how do partnerships make sure their accounting books actually match up with these tax reports? There must be a bridge.
There is. That bridge is Schedule M1 or Schedule M3 for larger partnerships. It's literally a reconciliation. It ties the book income, what the internal accounting shows, to the tax income reported to the IRS.
And what causes differences there typically?
Oh, common things like business meals, maybe you expense 100% on your books, but only 50% is deductible for tax.
Right.
Or tax-exempt interest, that's income on the books but not taxed. Depreciation is another big one where book and tax methods often differ.
That M1 sounds critical, but I can imagine someone thinking, oh, a small mismatch, it's probably fine. What's the real danger if that reconciliation isn't right? Can a little error cause big problems?
It really can. Small errors can unfortunately trigger a cascade of penalties. A late Form 1065, that's a penalty per partner per month. An incorrect K-1 flowing from that, another penalty potentially. And if your K-1 is wrong because of an error upstream, you could face underpayment penalties on your personal 1040. We're talking about specific IRS code sections here, like 6698, 6722, 6662. It gets serious fast.
Okay, so accuracy is paramount, not just for compliance, but to avoid this penalty chain.
Exactly. And this is where, good tax software is invaluable. The diagnostics can often flag potential mismatches or issues early on. It's like a first check.
Let's make this really practical.
Yeah.
Can we walk through an example? How does understanding a separately stated item actually save you money? Section 179 is always a popular one.
Great example. Section 179 lets you expense a qualified asset immediately instead of depreciating it over time.
Right, quicker write-off.
Yes.
Yeah.
But here's the nuance. The deduction amount is figured out at the partnership level, but the limit on how much you can actually deduct applies at your individual partner level. So let's say the partnership claims a $30,000 Section 179 deduction. You're a 50% partner, so your share is $15,000. Now, maybe the partnership itself actually had a $10,000 loss for the year.
Okay.
But if you personally also have, say, $80,000 in W-2 income from a job, you likely can take that full $15,000 deduction. Why? Because the limit is based on your total business income, which often includes W-2 wages.
Wow.
But flip that. If you had zero W-2 income and only your share of the partnership loss, you probably couldn't take that $15,000 deduction this year. It would carry forward.
That shows just how much your personal situation interacts with the partnership's numbers. It really brings home that pass-through concept.
Precisely. It's not theoretical at all.
What about the type of income itself? You mentioned capital gains earlier.
Yes. This is huge. Let's connect it back. The difference between ordinary income and long-term capital gains can have a massive impact on your tax bill.
Okay, give me the numbers.
All right, say you're allocated $20,000 in profit. If it's ordinary income and you're in, let's say, the 32% tax bracket, that's $6,400 in tax. But if that same $20,000 profit qualifies as a long-term capital gain and your rate for that is 15%, your tax is just $3,000.
That's a $3,400 difference.
Yes.
Just based on the character of the income.
Exactly. Proper classification isn't just paperwork. It's potentially thousands saved. Precision pays.
So wrapping this up, what's the big message for our listeners? We've seen Form 1065 isn't just a tax form to file and forget.
Definitely not.
Getting it right isn't only about avoiding trouble. It seems like it's a strategic shield against those penalties we talked about, but also, maybe even more importantly, a powerful sword for building wealth.
That's a great way to put it. The key takeaway really is, don't see your annual tax reporting as just looking backward. It's just a compliance chore. Think of it as a foundation for forward-looking business intelligence.
Using the past to inform the future.
Absolutely. Year after year, it builds insights to help you optimize your financial strategy.
So here's a final thought for you to consider. When was the last time you really looked deeply into your past partnership tax filings, like the 1065 and your K-1s? Could there be hidden opportunities, maybe patterns or misclassifications that could inform smarter strategic moves next year? What possibilities might you be leaving on the table?